The Pension Protection Act of 2006 is mostly about stuff I have no knowledge of. The stuff that Ray talked about today is very interesting to me, but I'd flunk a test on it, or wouldn't even take one. But there are certain provisions in the Act that have some relationship to pensions, but more relationship to general tax principles. And I tried to pick out those with that type of mix. I have 5. I'm going to focus primarily on the first 3. I start with the so-called QCD, the Qualified Charitable Distribution, the ability to make a direct distribution from an IRA to a charity and to achieve up to $100,000 in this year, an exclusion from gross income. I think that the way to understand this and put it in perspective is that this provision is all about the distinction between deductions and exclusions. There are basically only 2 ways you get a benefit under the Internal Revenue Code, and that's either an exclusion, or at least the income tax, either an exclusion or a deduction. Credits are a form of deduction. What this is doing is saying that by taking the distribution in the form of an exclusion, we are going to allow you to bypass some of the problems that exist if you have an inclusion and try to offset it by a deduction. The normal rules, and I think, by the way, the best way for us to start is if you would turn to my outline is under tab C, and if you go into that outline and find after my outline itself, there is the first excerpt from the Blue Book, the general explanation of the Joint Committee on Taxation, and that starts to be separately paginated, and it's page 5 of that first excerpt. And I'd like you to turn to that and give you a second or so to get there, because I would like to use the examples that the Joint Committee used in the Blue Book to illustrate and get through the outline on this part. Are we all set? This is example 1. Example 1 is a person who has a traditional IRA with a balance of $100,000, consisting solely of deductible contributions, no other IRA, and the entire balance is distributed to a 170B1A, capital A, charitable organization. The B1A charitable organizations are the so-called 50% charities, the publicly supported charities. The Jackson Center, I looked it up, and publication 78 is a 50% charity, so this could be used for qualified QCD to the Jackson Center. It cannot be used to that 509A3. That's a so-called supporting organization. It's a 50% charity, but it's a supporting organization, and it's accepted under this statute. For example, the UB Foundation was thinking of trying to track gifts to this, but UB Foundation is a supporting organization, so it doesn't qualify. The university would qualify as a 170B1A, but UB Foundation would not, and donor advisor funds are not eligible either. And as the example goes on to say, under the present law, the entire distribution of that $100,000 would be includable in the individual's income. That's because all of the contributions were deductible contributions. And that's one of the requirements. We're going to get to that a little later. And since the entire distribution would be includable in A's income, and since it's directly distributed to this 170B1A organization, then it is none of it is includable in A's income, and it's not taken into account in determining the charitable contributions deduction. Well, what does that mean? If it had been withdrawn under the old law and then contributed to the charity, then it would be includable in income. And then the question of whether it would be offset 100% would depend upon the charitable contribution deduction limitations. For example, it would be only if a person itemized, because the charitable deduction is only for people who itemize their deductions. It would have to satisfy the 50% test, and since it would be a charitable contribution deduction, it would be affected with respect to that 50% and would in turn affect other deductions to charity. So it would all be in that, in the pot of the charitable contributions deduction. This allows you to bypass those deductions because it's not a deduction, it's an exclusion. And the second part about it is that since it is an exclusion, it's not an inclusion. And inclusions also have bad effects in this area. And that is, for example, since it's an inclusion, it would increase, adjusted gross income, which could in turn restrict other deductions like the medical deduction. It could reduce or increase the reduction of those so-called miscellaneous itemized deductions under Section 67 because it increases AGI and therefore makes it more difficult with respect to the 2% floor that Section 67 imposes. And it also can increase the restrictions for itemizers under Section 68 because of the increase in adjusted gross income. And all of those on the inclusion side as well as the deduction side, all of those restrictions are bypassed by this. Now, the second example indicates another very important aspect of this new law. In this second example, and by the way, I picked these two examples because, you know, when I make my own hypos up and I have another sheet that you have for the next set of problems, they're my hypotheticals and they can come back and bite you. But these hypotheticals, you know, I can rely on because this is from the Joint Committee, and if they're wrong, well, they're wrong. I'm not wrong. So this, and I think these are right, these examples are correct. I have no problem with them. Example 2 is one where an individual has an IRA where some of the contributions were deductible and others were not. And it basically he has an 80% taxable, 20% non-taxable situation. And in this case, there's a balance of $100,000, but the distribution under this example, the QCD, the Qualified Charitable Distribution, is only $80,000, not the 100 that's in the first example. And that's distributed again to a 170B1A organization. And the beauty of the provision here, this new provision, is number one, that it will satisfy the minimum distribution rules, even though it's not included in income. And to the extent here, this would have been 80% included in income, and even though it's not included in income, it satisfies the minimum distribution rules. Secondly, it is considered to come first out of the taxable portion. So even though if this was taken out under the old law, $80,000 was withdrawn, it would be prorated 4/5, 1/5, and you'd only have $64,000 would have been excluded, and the other 16 would have been, I mean, only 64 would have been included and 16 would have been excluded. This entire 80 is considered to come from the taxable portion, and then is covered by the exclusion of this new rule, not the exclusion of the old rule, but the exclusion of the new rule, which then leaves $20,000 or 20% left to be excluded under the old rules, under the present old rules and not this new provision, which means that after the $80,000 is transferred to this qualified charity, then there's this $20,000 is sitting in there, and that can be withdrawn tax-free. And this brings me to something I'm a little, not unsure of, but I throw it out to you if you have any questions on it. I said to myself, well, supposing he takes out the $20,000 and donates it to charity. Can he take a charitable deduction for it? This is not going to be within the new rule now, because this would be withdrawn and donated, and not charitable contribution, charitable QCD, qualified charitable distribution. It could not, by the way, qualify under the new rule, because one of the provisions of the new rule is that the the distribution would have to be otherwise includable in gross income, so that this $20,000 would not have been includable in gross income, and therefore doesn't qualify for this new qualified charitable distribution. But so what? So what that means is, first, it's excludable under the old rule, and it could still be deductible, but you would have to run the gamut of those deduction limitations that I spoke of before, itemization, 50%, et cetera. Which then brought me to the question, well, this new rule, the QCDs, applies to both traditional IRAs and Roth IRAs. As was spoken this morning, Roth IRAs are generally withdrawals from those are generally non-taxable. Therefore, to the extent that a Roth IRA distribution would be non-taxable, it does not qualify for the QCD, because the statute requires that it would be otherwise includable in gross income. If it is a non-qualified distribution from a Roth IRA, and please don't ask me what that is, because I have no idea, that's where I'm out of my league completely, then it would qualify. But the thing that intrigued me, and the thing I had to check on with some people who practice in this area, is if you make this withdrawal from a qualified withdrawal from the Roth IRA, and you can't use this provision, can you still deduct it? It's the same question that I had with respect to the $20,000 in this example. And the answer that I was given was absolutely yes, as long as you're within the limitations, which is very interesting, because that's a double benefit. That's a double benefit. You get an exclusion and a deduction. You don't normally get those types of things in the code. This, for example, in the QCD itself, the statute specifically makes sure that you understand that you don't get to exclude this plus deduct it. And yet, that's exactly what can happen if you have an excludable distribution from a Roth IRA, just as you could have it on this $20,000. And there are, I once was talking to a very prominent, I won't tell who the lawyer is, who practices in this area, and I gave you half the answer, she told me that she gives IRAs to her kids for Christmas, and I said, you mean you give them the money and they deduct it? And she said, yes, why not? And I said, well, that's kind of a double deduction. And there are cases actually in other areas that say, for example, that you cannot, if you get a gift from somebody, that you cannot use that as a business expense because you're getting a double benefit. I think those cases are wrong, but they're out there. I think that's what occasioned my call to this practitioner. Can you do this with this Roth IRA? And the answer is yes, and I guess it would also be true with respect to this $20,000. So now if you hop back from these examples right back to the beginning of my outline, which is on page 1, and you go down to D, just to kind of wrap up on some of the other provisions here, it applies, this change applies only in 2007. There is some hope from the charities that they can get Congress to extend it, but right now it expires on December 31st, 2007. And that brings up a question that was that I saw in some of the literature referred to the fact that, well, what happens if all of a sudden planned people get, 11,000 requests to transfer on December 30th to transfer these things directly to charity, and they have to do it by the next day. And that might be with respect to people who only reach 70.5 by December 30th, or people who have reached it before but do things like myself and put things off. And one of the interesting answers to one of the questions in notice, I won't bother taking up the time, but it's question 41 in the materials here that you have. It's actually, you probably can do it easily. It's the very last, actually it's the very last page of your materials before the D, right before that index D. There's this last page, and it's question 41. And that question, this is from the IRS, states, is a check from an IRA made payable to a charitable organization and delivered by the IRA owner to the charitable, a direct payment from such organization? And the answer given by the IRS is yes, which then in turn, since I don't know much about this area, pensions and IRAs generally, I said to myself, well, is there such a thing as an IRA that you can write checks on? And I asked a couple of people who were very knowledgeable in this area, and their first answer was, I have no idea. But upon further research, we found that people like, I think like Merrill Lynch, people like USB, they will do it for you. They will arrange it so that you can have check writing privileges on your IRA. I talked to a very prominent banker about this, and he said they at this point do not have that. They do not offer IRAs with check writing privileges. So that with respect to IRAs, that where the bank is the one that has to make the direct contribution to the charity, then you're well advised to do it before December 30th to get it in by December 31st, 2007. To go on with this Part D here, we've already mentioned that it only applies to these 50% charities. In number 3, you see that the restriction that it only applies if a charitable deduction for the entire distribution would have been allowable under present law. What does that mean? Well, it means, for example, that, to take a very simple example, if you have a contribution to a charity and you get a quid pro quo, you give X amount of dollars, and in return you get a chance on the lottery, or you get a free dinner or whatever, then that's not entirely deductible. That is deductible only up to the extent of the overage. What this provision says, this type of QCD cannot be made, cannot take advantage of the exclusion. It has to be entirely, the deduction would have been for the entire amount that had been withdrawn and transferred. More importantly, I think, and the committee reports do not speak to this, but I did some research into the genesis of this statute, and this statute had some predecessors 2 or 3 years ago where it was going to be applicable to distributions to charitable remainder trusts and charitable lead trusts. But that has been taken out of this statute so that those types of distributions do not qualify. And the reason they don't is because of this provision that I have here on page 2, number 3, that it applies only if the charitable deduction would have been allowable for the entire distribution. We mentioned that it doesn't give rise to its own charitable deduction, doesn't affect the percentage limitations for other charitable contributions. Also the fact that it would have to have been includable in gross income. That's where we talked about the Roth IRA. And it is the fact that it's considered a distribution to the taxpayer, even though it's not includable in income. That's the genesis of the fact of its satisfying the minimum distribution rules. And then finally, that directly to the trustee has to be directly to the trustee. It cannot be withdrawn and contributed. If it's withdrawn and contributed, then it does not qualify. And that's why I think that check comes in. If it's written on, if you write a check on it, then it's not considered withdrawn and contributed. It's considered to be directly transferred. All right, so that's that's the first one. The second and the third one really have nothing to do with pensions. But just like anything else, somebody who sees a big statute going through says, let's see if we can get in some of these provisions we've been trying to get in for years, and we have not been able to do it. And they were able to do that with respect to these next two items. And I would like you to look at that handout that Mary Parsons gave you as you came in, because I think that's the efficient way of getting through these materials. The first deals with the so-called related use requirement, which was part of the 1969 Tax Reform Act, which is just about the time I started to teach taxation. It was the same statute that gave rise to charitable remainders and other types of restrictions on charitable giving. And it was, I think, a fairly, history now, and people would, I think, agree that it was really an overreaction on the part of Congress to abuses. This material we're going to do at this point is just a continuation of that 1969 Reform Act and a continuation of what many people would call an overreaction to abuses in this area. The related use gift concept applies only to gifts of tangible personal property. The first example I give you here, where if the taxpayer gives stock with the basis of 100, fair market value of 200, bought some years ago so that if sold it would give rise to long-term capital gain. If that taxpayer gives that stock to either a museum or to the Cancer Society, that is, if it gives it to an organization which is probably going to sell it to get the cash to support its activities, the taxpayer still is allowed to take a deduction for the full fair market value. And the name of the game in this whole area on related use gifts, the whole name of the game is, to what extent will the taxpayer be able to get a deduction and not have to pay tax on the inherent appreciation in the property. And in this case, where it's a gift of intangible, the stock is considered to be intangible personal property, then it really makes no difference what type of charity you give it to. There is a 30% limitation on AGI for gifts of so-called long-term capital gain property, even if it's intangible. But aside from that, this is 100% deductible. There are areas here that people have to be aware of, and there's all sorts of case law where people, for example, have where there's been, for example, a plan for redemption of the stock, or where people have actually entered into a contract for the sale of the stock, and then they give it to charity before things have completely come to fruition, and the IRS takes the position, no, it's too late to do that, you're going to pay tax on the gain because it's the same as if you sold it and gave the proceeds to the charity, which is fine, you can get the deduction, but you're still going to pay tax on the gain. So you have to be careful of that. And basically, this is the same problem. It's not a question of a so-called assignment of income like those other cases are, but it's a question of should we allow the deduction for the full amount, even though we know that the charity is probably going to sell this property? And the answer in problem 1 is yes. And the answer in problem 2 is no. And the only difference between number 1 and number 2 is that in number 1 you got stock, and number 2 you got a painting. What the this is section 170E1A of the code. It says that if you give tangible personal property to an organization and the tangible personal property is not related and will not be used for in a way that's related to the exemption of the organization to which you gave the property, then we are going to assume that it's going to be sold. And since it's going to be sold, we're going to say it's the same as if you sold it and gave the proceeds to charity. And the way we enforce that is to require you to reduce your deduction by the amount of long-term capital gain that would have occurred if you had sold it. And so that, in effect, that means you get only in number 2 a deduction up to your basis in this painting, which is 100 rather than the 200. On the other hand, if number 3, if the painting is given to a charity that's going to use the property for its exempt function, like the museum, then it's treated the same as number 1. It's treated the same as if you gave the stock, which in turn is treated really the same as if you gave cash. In number 4, we have now the new law, which is designed for the first time to do 2 things. Well, basically one thing, but let's take problem number 4. It says that if in fact you give it to a museum and it's a related use type of situation, but the museum doesn't use it for that and in fact sells it, if it's sold in the same year in which it's given, a number 4, which is hypothetical number 4, then you don't get any deduction at all you don't get any deduction except for your basis in the property. It's treated again as though you sold the property and it's reduced. And that same notion under the new law is brought over into hypothetical number 5. If the painting is not sold by the museum in the same year in which it is given, but it is sold within 3 years of its contribution, then in effect you have a recapture, or really what you would think of in terms of general tax principles as the application of the tax benefit rule. And what the statute does is to say that when it's sold in year 2, the taxpayer who has given this now has to include in income. This is solely, by the way, these provisions here, related use gifts, are solely income tax provisions. They're not related to gift or estate tax. This is solely income tax stuff. And it says that in year 2, when the property is sold for $500, then the deduction is recaptured. That is to say, the taxpayer in number 5, in year number 5, has to include in gross income and as ordinary income, not as capital gain that would have occurred if he had sold it way back then. But it includes in ordinary income the $100 that he saved in the first year by giving it to that museum. So the deduction in the first year is for $200, but then $100 of it is recaptured in year 2 when the charity sells it. Even though charity sold it for $500, the recapture is only limited to, in effect, to the excess deduction that was taken, and that excess deduction is measured by the amount that would have been long-term capital gain if it had been sold way back then, but it is recaptured not as long-term capital gain, but as ordinary income. So there's a penalty recapture there. Okay. The second, that's the so-called provisions dealing with related use. The second problem in the materials in the second part of this handout here on fractional interest gifts are dizzyingly complicated, and I think it's fair to say that if you struggle with these long enough, you will see eventually that no one probably in his or her right mind is ever going to be making fractional interest gifts to charity anymore because of the provisions of this new statute. The hypothetical number 1 gives you the general rule that was applicable before the new law and is still applicable, and that is that you normally do not get any charitable contribution for a gift of so-called partial interest in property. In this example, in number 1, the taxpayer gives a remainder interest in the painting, retaining a life estate, and that specifically denied a deduction, completely denied a deduction. It's a zero deduction in this type of situation. In the second hypothetical, we begin to look at what the new law provides. Because in this example, the taxpayer has given a partial interest, but has given what's called a vertical slice or an undivided portion. In effect, it's done by making the museum here a tenant in common of this painting up to the extent of 1/2. The museum gets 1/2 or a percentage or a fractional interest of all the interest that the taxpayer had, which would be what we would call a fee simple in this painting, and gets 50% of that. There is a little leniency here, even under the old law and still under the new law, but no one's, I think, going to ever use it now under the new law, because it does not require that the museum be allowed to have the right to possess the painting for some part of every second of every day of the whole year. You can get away with by saying that the museum can have it for 6 months out of the year, because that's half the year, and you're giving them half the interest, so 6 months is half the year. Even though you can have it for the first 6 months, and they get it for the second 6 months, the Treasury allows that. And it's still allowed. But what happens here is exemplified by the rest of this hypothetical. It happens under the new law. Suppose 2 years later, the taxpayer decides to transfer the rest of the interest, the other half of the interest. And by that time, the painting has increased in value from 200 to 500. What's the result of that? Well, first, go back to the year when he gives the first half. The deduction there is 50% of the fair market value, assuming the related use stuff that we talked about before is satisfied. He gets a deduction for the full fair market value. He's only given a half, so only gets half the fair market value, but that's a $100 deduction. But now the statute says if later on he gives the second half, then in valuing that later deduction, he takes the percentage of the lesser of the fair market value at the time that he gives this later one, which is 500, or the time in which he made the initial contribution, which is 200, so that his deduction here is only 1/2 of the original 200. So his deduction here, instead of being 250, which he's really given to the charity, at least that's what he says he's done, is only for 100. And that's applicable for estate and, for gift and income tax purposes. What's the effect of that? Well, the statute says the regulations are to take care of this and all that kind of stuff, but the effect of it basically is that he only gets a deduction for income tax purposes of 100, even though he's made a contribution of 250, and for gift tax purposes, the amount of the gift is going to be 250 minus the annual exclusion, but he's only going to get a charitable deduction again for 100, so he's going to have to pay not pay, but he's going to have to consider that to be a taxable gift to that extent, because you remember the way the charitable contribution works under the gift tax. You know, you include property in a taxable gift, and then you subtract out the amount of the deduction. It's not an exclusion, it's a deduction. And this limitation on the valuation of the deduction really means that this creates a taxable gift that would otherwise not be there. That in and of itself, frankly, I could stop right there. That in and of itself, I think, would be enough to say to somebody, never use this, because if the value of that contributed property goes up, and you give the rest of it, as we will see, you're going to have to give, or else you have a recapture penalty, you're going to lose the original deduction, then if it goes up, you're not going to get the deduction either for income or gift tax purposes of the amount that you've actually given. Number three, I say take the same hypothetical as number two, but this taxpayer now doesn't transfer the remaining 1/2 until 11 years later. And number two, he transferred it within 2 years. The statute, the second part of this new statute says, in order to correct what they thought was the abuse of people giving a partial interest and then holding on to this property, basically not giving possession of the property to the charity, but still taking the deduction, says what we're going to do is, in effect, we're going to force you to give the charity possession by, first of all, we're going to make you give all of the interest in the property by 10 years, the earlier of 10 years of your death from the time of the first contribution. So that in this hypothetical number three, since T doesn't give the remaining 1/2 until 11 years later, he gets that first deduction for 100. He is hit by that valuation deduction situation we talked about in number two in year 11, but more importantly, in year 10, when that, when the clock strikes and it's 10 years after the initial contribution and he has not given the entire interest, the statute comes in and says that the deduction for both income tax and gift tax purposes is recaptured. Again, that's all it says. It doesn't say what does that mean. I think what it has to mean, again, for income tax purposes, is you have to have an inclusion in income. You have to include in income the amount of the deduction that you took in the first instance, which was here would be 100. For gift tax purposes, I think it once again means it's going to give rise to a taxable gift. When I say taxable gift, I mean you're going to pay tax on it, but that's the phrase in the gift tax, a taxable gift. Number four, I've seen some statements to the effect that this can't be true, what I'm going to say, but I think it is true under the statute, which is suppose that the gift is given, but the person doesn't give the remaining 1/2 in year 2, and dies 5 years later. He's still within the 10-year period, but he dies 5 years later. Well, now the statute says if you don't give the entire gift, remaining part of the gift, by the earlier of 10 years or your death, then the recapture applies. So and the valuation rules still apply. So what would that mean? I think it has to mean, although maybe they'll back off from this when they write the regulations, I think it has to mean that when the person dies, the full value of the remaining interest in that painting is in his or her gross estate, but the deduction for estate tax purposes is only 1/2 the original value, not 1/2 of the value at the time of death, even though the whole 1/2 is included in the gross estate. And secondly, the original deduction of 100 is recouped as of the death of the testator, is recouped with respect to both the income tax and the gift tax, which means, I take it, the regulations are going to say on the final return that's filed for this person under the income tax, there's going to be a recapture of that original deduction as gross income, and that there will be considered to be a gift for gift tax purposes at the time of death. Not an estate tax. The estate tax deals with the other half, but the gift is with respect to the first half that is recaptured. And then my final example, number 5, basically says, without making you any more confused, basically says that the same rules with respect to that we applied in number 4 will also apply even if the taxpayer has satisfied this requirement of giving up all the interest before the earlier of 10 years or death, has done that, but if the donee has not taken possession and actually used the painting. This is to enforce this notion that we don't want them this painting just hanging on the wall of the taxpayer, that unless the museum has actually taken possession before death or the 10-year period and actually used the property for its exempt purposes, then all of those recaptures that we talked about in number 4 are going to apply as well in that situation. So, I mean, I think, again, the name of the game here, and I haven't gotten through some of the other restrictions on it, the name of the game here is that once you know about this, I think it kind of borders on malpractice to suggest anybody give an initial fractional interest unless you really dot your I's and cross your T's, and because a person, among other things, can die at any time, and you're going to be involved with this. Now, you've got to watch the regulations, see if they are more lenient than the statute appears to be. All right, that really takes us through 3 out of the 5. I'm really only going to have time to do the 4th one. The 5th one, I think, is fairly self-explanatory, and that's the increase in the penalties for overvaluation basically for income tax purposes and undervaluation for estate and gift tax purposes. They've tightened up what is considered a substantial overvaluation or undervaluation and what's considered a gross undervaluation and overvaluation. And they've also put a new type of penalty on appraisers and made appraisers much more susceptible to regulation. And again, I think that's set forth pretty straightforward in the materials. I would mention this one thing that I came upon and I didn't realize that was a little news. You know that in the area of accuracy-related penalties, which these undervaluations and overvaluations are part of, the so-called accuracy-related penalty of 6662 of the code, there is, with respect to a large area there, the ability to avoid those penalties by disclosing on the return the position of the taxpayer as long as the taxpayer has a reasonable basis for that position. That disclosure way out is specifically not applicable and never has been considered applicable to these valuation misstatements, either overvaluation or undervaluation. And as the materials point out, even the overall escape hatch of so-called reasonable cause and good faith, which is a way out from all of the accuracy-related penalties, has been cut back here with respect to gross misstatements of valuation. And so that the reasonable cause doesn't apply to that any longer. The final one that I do want to take a few minutes on is the one that Ray Barr said that I would be dealing with, which is the rollover by a non-spouse. And this is a very humbling exercise on my part to try to figure out in 2 months what that meant. And I still haven't. I think I know 90% of it, but that's like, horseshoes. It's not good enough. I do know the genesis of it. One of the interesting things about my exercise here was to try to find out what the reasons for these changes were. I gave you the benefit of my research on the reasons for these changes. In many cases, the committee reports will give that. This particular area, you find very little by way of statements in the reports, in the blue book as to the reasons for the change. But I found some of them by going back to old committee reports. And the one here, the reason for this seems to be that there are plans out there, and Ray was saying he knows several plans where the only benefit that can be given to a non-spouse is a lump sum benefit. And in that type of situation, if a person dies and the only benefit that can be taken is a lump sum benefit, then that has to be included in income as a lump sum. Whereas if it was provided for a spouse, then the spouse could do a rollover. And what this provision basically does is to say we're going to, for that type of problem, we're going to give a non-spouse the same ability to roll over that a spouse would have, to avoid having to pay tax on a lump sum, and if that's the only thing this plan provides. Then the statute says that it has to be a rollover to an IRA that is established for the purposes of accepting that rollover, and that rollover, that IRA that it's rolled over into, will be considered a so-called inherited IRA. And if you will look at my materials, you will see that's where I copped out. And I said that means that allows the designated beneficiary who is a non-spouse and has rolled it over to be able to preserve the ability to take these payouts over life expectancy. And that's where I said to Ray before this, could I then turn to you, Ray, and have you explain just what that means that I just said? And he said yes, he would. So would you mind, Ray? And then I'm through. So I'm through right now, as a matter of fact.
In that particular area, what I thought was fairly clear, the IRS keeps coming out with more announcements saying that what I thought was clear is unclear. But essentially what it allows a participant or a designated beneficiary to do is, like Professor Joyce said, defer the tax to a later year. They don't have to pay tax on that lump sum distribution. But once the money goes into the IRA, and by the way, you cannot roll over what had to be distributed to the participant before his death. If there was a required minimum distribution already due him, you cannot roll that over, but you could roll the rest or transfer the rest over. It allows the beneficiary to make a decision once the money goes into the IRA, whether he or she wants to take it over the 5-year period or take it over the life expectancy. The rules really relate back to what the plan said. So if the plan said it comes out as a lump sum distribution, how does the beneficiary have the right to take it over 5 years or life expectancy? Well, the IRS came out and clarified that even if the plan says it's a lump sum only, once the money goes into the IRA, the beneficiary has the right to take it out over 5 years or over the beneficiary's life expectancy. Except in a case where the participant had already begun to receive payments, then they have to continue at least as rapidly as under the method in effect prior to the participant's death.
Which is, by the way, spelled out in Ray's, on page 9 of Ray's outline. It fills in the general provisions that I have in mind. Okay? Thank you very much.
Thank you.